Hi, today we're talking about the line. Where's the line that you don't want to cross when it comes to deductions on your taxes? I'm Dee Dee Jones with Innovative Financial, bringing you Money Mastery with Dee Dee. And today it is Tax Talk Day. It's tax season as I record this. And I was asked by my dentist, bless her heart, how aggressive should I be with my tax deductions? Because my friends are doing this and that and the other. And as we were talking, and you know how it is with the dentist, as best we can, really the key to tax deductions is, reading the rules around it, but reasonable person test. If a reasonable person can look at your deduction like you, say, okay, that makes sense. That passes test A, and then test B or 2 is a reasonable IRS tax auditor going to look at that and say, yeah, that makes sense. If your deduction passes those 2 tests, you're probably fine. But let's talk a little bit more about where that line might be. What are the consequences if you cross the line and get caught? That's really kind of the big key. Right now, the IRS is pretty underfunded, not auditing as much as they have in the past. So for better or for worse, a lot of aggressive deductions are going unobserved. So if you are observed, though, let's talk about what happens if you inflate your deductions. What are the risks that you might be subject to? The first is you could be fined 20% of the disallowed amount for filing an erroneous claim for a refund or credit. Okay, so 20% off the top. And if your return rises to the level of frivolous, that it means it doesn't include enough information to figure the tax correctly, you could be hit with a $5,000 fine. And wait, we're not done. In addition to the full amount of tax owed, you could be assessed a penalty of 75% of the amount if the underpayment is deemed to be tax fraud. Now, I'm not an attorney, so defining exactly where does a mistake end and fraud begins, that's for bigger guns than I. And if those aren't scary enough, you could be subject to prosecution for tax evasion, willful failure to file a return, fraud, false statements, preparing and filing a false fraudulent return, or possibly even identity theft, depending on what you're doing. So that's the bad news. If you cross this line in a big bad way, these are possible penalties. So you can understand why many people are concerned about where that line is. I want to take deductions that I'm entitled to, but I don't want to take so many that I put myself and my family at risk for all of these other bad outcomes, actually. So let's talk about what are risky deductions. Now, this is an unusual topic in that deductions apply to individuals as itemized deductions, but deductions also happen for businesses. And today, probably, if you're watching this, you might be self-employed or own a small business. The same idea around what is deductible in a philosophical sense applies to both that reasonable person and a reasonable IRS auditor. So what are some things that can get you in trouble? So automobile expenses are one. If you take a vehicle and say it's 100% business use, that's going to be a flag. There's a really good chance that the IRS is going to come out and check on that because very few cars are 100% business. So be sure you're really careful about that. In fact, when it comes to automobiles, it's required that you keep a contemporaneous log of your mileage. That in the olden days, which not that long ago, that meant keeping a written record of where you went and what the business purpose was. Nowadays, thankfully, we have things on our smartphones that can track our travels, and we can designate them very much like Tinder, right or left, business or personal, and keep track of it that way. But it's contemporaneous, meaning that it's happening as you go. If you get audited and you didn't keep records, all of a sudden nothing's going to be allowed because nothing was kept contemporaneously. So avoid 100% automobile usage. And if you do have a car that you use partly for business, keep contemporaneous records. Utilize the apps that are available to you because it's way easier than pencil and paper, having done the pencil and paper in the past. There's a whole lot of events that will trigger the IRS looking at you. And sometimes it's a matter of, are you taking more than the average amount of maybe a charitable contribution or medical or taxes? So the IRS has way more data than most of us, and they know what the averages are by your income, by your filing status, by your family size, by your geographic location. They know what someone like you, on average, will do in each of these categories. And if you're too far out of the bounds, that's going to trigger an audit risk. Now, an audit in this case may simply be a letter saying, gosh, you made, a $20,000 charitable contribution, and can you please provide documentation to that? Well, hopefully, if you really made a charitable contribution of that size, you have records to support it. If not, you might be subject to those penalties that I described as we started out. So lesson number 47 or whatever we're on here, keep records of your deductions. Know what can be deducted. When it comes to charitable contributions, most of the time you're going to get a receipt from that charity. Be sure you follow the rules, keep track of the deductions around that. The next one are medical expenses. Chances are most people who are able to deduct medical expenses are folks who are in nursing homes, basically. You can only deduct medical expenses. This is really hard to say. You may only deduct medical expenses to the extent that they exceed 7.5% of your adjusted gross income, which is straight out of the code. I apologize, but it's the cleanest way of saying it. So you look at your AGI, what's 7.5% of that? Only the medical expenses that exceed that amount are deductible. And then you have to be able to itemize anyhow. So deducting medical expenses is a pretty high hurdle to hit these days. But if you have catastrophic medical year, which, gosh, after 2020, there's a fair chance that there's people watching this that have had that kind of year. That's how much you can deduct. What happens inside medical expenses is games start to be played. People put their hot tub, they put their vitamins, they put their cosmetic surgery. In most cases, those aren't going to be deductible. Now, I know there's special rules around that. You can go look those up. We're talking in general. General stuff can be deducted. Don't go outside the norm. If you have a really high medical deduction and you're not elderly, that's a red flag for an audit. And finally, making sure that your itemized deduction of taxes makes sense. Again, they've got tons of data. They're going to know whether or not you have it correct or not. So that's one way of looking at it. It's like, are you within the range of normal for someone in your area, your filing status, and your family structure? If you're beyond those and you have legitimate deductions, don't take my telling you about this to not take them. Absolutely take them, but understand that you're at higher risk of talking with your friendly IRS agent. Just be prepared to provide the documentation and all should end well. It's my experience that getting a letter from the IRS is really, really one of the most stressful things people can ever have happen to them. So if you know that you might be on that audit risk, you can be more prepared for that letter and ready to respond if it does in fact arrive. Some other things to think about. In 2017, the Tax Cut and Jobs Act said no more moving expenses as far as items that are deductible. There might be folks out there who are trying to find ways to deduct their moving expenses. I'm here to tell you they've really shut that down. It's going to be difficult. No matter how much you pay an expert to help you deduct those moving expenses, the law explicitly says they are not deductible. You're putting yourself at significant audit risk and penalty risk because you're just straight up not following the rules. So it's important to know what the rules are or work with somebody who's very knowledgeable and is looking out for you. Okay. Business trips, if you're a business person, business trips are certainly deductible, but only business trips for business. So you've got to be careful if you go to the conference in Hawaii and then bring your family and stay for another week or two. You're going to have to be very careful about segregating out the components that relate to the business trip, where you were learning about whatever your profession is, and the time that you spent with your family actually vacationing. We all just want to take trips. So just understand you need to be very careful about breaking those out. If you have a very big line item about travel and business trips, again, could be that red flag for the audit. I'm not going to go on. I think you get the idea. Be reasonable so that when the IRS calls, you can confidently say, yeah, that's a for real thing. Let me get you documentation. The last thing you want to do is have the IRS contact you and be flat-footed and go, oh, my accountant said that that'd be okay, when in fact, it's something that's not going to be okay. You won't have documentation for it. It's going to make you stressed and uncomfortable. You're not going to really like the tax preparer that gave you that advice. So it's not in their interest to do it, but it happens. All comes down to being reasonable. Hopefully we're all reasonable. We want to make the system work together. I want to pay my fair share of taxes, but it's my right to not pay any more than that. Same thing goes for you. So it's important that we all work together as a team, make the system work. But no one said you have to pay any more than the law requires. So with that, thanks for joining me today. If you've got questions on taxes, leave them in the comments below. Have a terrific day.